How's it going, everyone? In this video, I'm going to try and construct my all-weather portfolio, targeting 20% returns annually. So exactly what is the Ray Dalio's all-weather portfolio? And we'll see here. All-weather portfolio ETF allocations and returns. Here's the allocation of Ray Dalio's all-weather portfolio. 30% stocks, 55% fixed income, 15% commodity. So 30% stocks is mainly US large cap, VTI, Vanguard VTI. And then we have the fixed income at 55%, and that's into two parts. There is the long term for 40% long-term bonds, TLT, and 15% for medium-term bonds. And then for commodities, we have 7.5% in gold and 7.5% in mixed commodities. So the distribution, 30% VTI, 40% TLT, 15% IEI, 7.5% GLD, 7.5% GSG. And then we'll head to Portfolio Visualizer to see how it performs. Here's the website Portfolio Visualizer, and we go to Backtest Portfolio. For Portfolio 1, we can select Ray Dalio's All Weather. And then we'll benchmark it to SPY, the S&P 500 index. And then we custom portfolio number 1 as Ray Dalio All Weather, and then we analyze. We see here from 2007 to right now, September 2020, the average returns per year for Ray Dalio's is 7.93%. But the SPY has returned 8.65%, so it's higher for the SPY. But we look a little bit further, standard deviation, which means how volatile this index is. For the Ray Dalio's, only 7.3%, so it doesn't swing very much. But for the SPY, it's double that at 15.38, which means it's very volatile. For the best year, Ray Dalio has done 18.28%, while the SPY is 32.3%. But that really doesn't matter because we're in it for the long run. We only care about the year on year. This number here, the absolute highlight here is the worst year. We see for the Ray Dalio All Weather, the worst year was only 3.25%, while for the SPY, the worst year is minus 36.81. And then the max drawdown, which means for the worst year, the highest point to the lowest point, it was only minus 12 for Ray Dalio, while it was minus 50.8 for the SPY. Here, the Sharpe ratio, it just means how all the asset classes are related. The closer to 1 this number is, which means things are just not very correlated. When the market tanks, it doesn't mean that gold and the bond will tank with it. Therefore, our portfolio is well balanced. As we can see here, the US market correlation is only 0.42% because we only have 30% in the stock market. And there is some correlation between the gold and the treasury and the commodities, but not very much, so it's only 0.42. While the SPY is 100% correlated because it is. So if the market tanks 50% like this, then your whole portfolio is down 50%. This is the gist of the all-weather portfolio. But what I'm going to do is alter it to suit my style, try to outperform it while having the risk management. So in portfolio 2, I'm just going to call it Mindful All-Weather. What I'm going to do is split this VTI 30% into two sectors. I'm going to keep 15% in VTI. TLT, the long-term bonds, I'm going to keep that as well. IEF, the medium-term bonds, I'm going to keep that at 15. We're going to take a quick look and compare this DBC to GLD. Okay, so DBC, okay, I'm going to compare it to GLD. We see that GSG from March of this year has actually gone down in value. So it was not a good hedge for the stock market. While the gold has gone up. It's gone up 20%, but the GSG is actually down 6%. So why am I holding this kind of asset? I'm going to get rid of it and just hold more gold as a hedge. So we're going to drop the DBC and put that portion into the GLD. And for the remaining 15%, we will put 15 in the VTI, but for the other 15, we're going to put it into QQQ, which is the NASDAQ index. Because I believe this tech revolution just cannot be stopped. Okay, so that's everything. So 40 plus 4 times 15 is 100. We can analyze the portfolios here. Ray Dalio All Weather, 7.9%. Mindful All Weather is 9.88%. And its best year beats the Ray Dalio's All-Weather at 20%, while the worst year beats the other two as well at minus 158%. For the max drawdown, it's also lower than Ray Dalio's All-Weather. This Sharpe ratio and US market correlation is also lower, so is well diversified. I'm going to stick with this mindful all-weather distribution, VTI at 15%, TLT at 40%, IEF, GLD, and QQQ at 15%. So that's a total of 9.88% per year. But how am I going to get it from 10% to 20%? I'm going to do that by leveraging. As some of you may know, I use Interactive Brokers, and the margin rates there, interest charge on margin loans, is 1.59%. If we go back here and we have 9.88, we multiply the portfolio by 2, so we gain possibly 20% per year, while the expenses are 1.59% per year. So subtracting the 2, 20 minus 1.59 is about 18.41%. Alright, so here's my account at Interactive Brokers. I put in $5,000 here, but we're going to leverage it to $10,000. Before we do that, we need to change this Canadian dollars into US dollars. So how would I do that? USD.CAD, and then Forex, and I have to buy. I have to buy a certain amount of US dollars. So right now the rate is 1.33056. So 5,000 divided by 1.33056. That's approximately 3757. Alright, so 3757, and then we're going to do a preview. So it's less than $5,000, so it shouldn't be a problem. We can submit. Okay, I don't care. Accept. So order submitted. Okay, perfect. So I have 3,755 of US dollars. And now we're going to put it into the spreadsheet 3755 and see how much we're buying of each asset. So right now I'm going to calculate 3755. So 15% of that would be $563 and 40% would be $1,500. But as I said, I'm going to multiply these by 2. For the 4 assets, we're going to buy 1126.5. For the 40%, we're going to do $3,004 approximately. Let's go back and execute it. We're going to do create new order. What is it? TLT, right? TLT. We're going to do TLT. All right. So TLT right now is at 162.6. This feature is pretty cool. I just put in US dollars. As I mentioned before, we're going to buy $3,004 of USD. Quantity 3,004. And then limit the price at 162.6. And then we're going to do preview. Approximately I'll get 18.47 shares because we're going to do fractionals here. Let's try it out. Override and submit. Okay, so this has been filled by TLT position. And now we're going to do it for the other 3. Okay, now we look at the orders. So as we can see here, these 3 have been filled, but these 2 haven't. So we're going to change it a little bit, moderate. We're going to modify it and then add another 2 cents, modify order. We'll just do market orders if it doesn't work. Okay, we'll go back and then we'll do market. Because over a long 10-year run, it doesn't even matter, these couple of cents. Okay, that's executed. Everything has been filled. Now we'll look at the portfolio now. Edit the column to get the percentages out. Percentage of market value, let's do that. Okay, so this makes sense. So if we divide everything by 2, we'll have 40 and 15 for these 4 assets. And then we'll see that we are borrowing $3,500. Okay, so this portfolio is done. This is my mindful all-weather multiplied by 2. And this is another black hole portfolio for me. So I just put in money every single month, possibly 5,000 every single month, and just distribute it across. So I'm going to do it the first Friday of every month. Put in 5,000, distribute it by 40% and 15 across. But I'll rebalance all these holdings. Let's say next month, the GLD somehow came down to about 13%. So I have to distribute more to it so it maintains a 15% across this portfolio. This monthly contribution and redistribution will really balance the portfolio from dollar cost averaging. So as I mentioned, if we do get this 9.88, let's say 10% optimistically, we're multiplying that by 2, so we get 20, and then the interest rate is about 2%, so we have 18%. So now we have all these holdings. As some of you may know, I like to play in the options market. Over a long-term trend, there are lots of dips in the markets. Lots of dips. And we've seen one this year, it dropped about 35%. If we draw an imaginary line, let's say something like this, and every single month, when an asset class overshoots by maybe 5, 10, 15%, I can sell a call option to get more premiums. And every time when it drops 5, 10, 15%, I can sell a put option and get some premiums there. So this is how I'll squeeze out another 2+% over the year to meet our 20% ROI target. This portfolio just makes sense to me. At minus 1.58% per year, we can easily multiply this return by 2x. I have an analogy here. Let's say if you're at the casino and you're playing at the roulette table. At the side of the table, they say that the minimum bet for the outside is $10, let's say. For the minimum bet from the inside is only 50 cents. And the reasoning behind that is because the odds of hitting any of these numbers is 1 in 37, which is less than 3%. But the odds of hitting the red is about 48% because there's a 0. So this kind of demonstrates that if the risk is high, then you can't bet that much into it. I'll never go into a roulette table and bet $100 on black 17, but it's very possible that I bet $100 on black because the odds are close to 50%. Coming back to our case, if we know that the worst years would be minus 10%, if we double a whole portfolio is minus 20%. This I can stomach. But if I double down on the SPY, minus 50%, max drawdown, this will be minus 100%. So your whole portfolio will be gone. That's when they do a margin call and just liquidate all your positions. I don't know. So all of this makes sense to me. I'd love to hear what you guys think of my approach here. Am I crazy or is there something here? I can always tweak it a little bit, but I think the general direction I'm gonna stick with. So why did I create this all-weather portfolio? The whole concept behind it is to avoid stock picking and having a system every month to distribute across the 5 different asset classes. This black hole method is very similar to my dividends account. We don't plan to withdraw anything until the end goal is reached. Now let's see how far this can go. If we go back to this backtest portfolio, we'll play a little bit with these parameters. So we're going to include year to date. Initial investment, we'll make it 5,000. Oh no, wait, because we're doubling the 5,000, so it'll be 10,000 since we're borrowing 5,000. And every single month we'll contribute another $10,000. And we'll adjust for inflation. Contribution frequency is every month. We rebalance every month as I mentioned before. So every month I'll contribute, so the distribution is about 15% for the forward classes and 40% for the long-term bonds. So we'll analyze a portfolio here. So right here it says mindful all weather, 10,000 initial balance, monthly 10,000 distribution, and the final balance would be 3.9 million. But this is for 2007 to year 2020. So that's a good 13 years. We'll narrow it down to maybe 5 years. So 2016 to 2020, that's about 5-year run. If I implement this system for 5 years, what's gonna happen? Okay, so it'll be approximately 852. So how about comparing it to 6 years? Will it hit that $1 million mark? There we go. So if I implement this for 6 years, it's very possible that it could be $1 million account. We'll do some basic calculations here. If I put in 5,000 of my own money, 5,000 times 12 months a year times 6 years, we put in $360,000, approximately, let's say 6 to 7 years. This portfolio could possibly be $1 million. Again, if you found any value in this video, hit the like button, subscribe, and comment down below. This really supports the channel. Thank you, take care, and I'll see you in the next one.